Hello and welcome back. In this video, we are going to deep dive into the world of assets and balance sheet, and we are going to discuss what they represent. As an entrepreneur or a non-finance person, it is crucial to have a solid understanding of assets as they form the backbone of your balance sheet. So sit tight and let's get started. To begin with, let's define what assets are. Assets are resources that a company owns and that are expected to provide future economic benefit. There are two types of assets, current assets and non-current assets. Cash, accounts receivable, stock, and other assets which can be turned into cash within a year are examples of current assets. On the other hand, non-current assets are long-term investments like property, plant and equipments which can be turned into cash in less than a year. Assets play a crucial role in financial health of a company. The assets of a company determine how it can make money, pay its bills, and invest in growth. In the order of liquidity, cash is considered the most liquid asset and is the lifeblood of any business. Cash needs to be carefully managed to make sure the company has enough to pay its bill. Then next is accounts receivable. Accounts receivable represents money owed to the company by its customers. Careful management of accounts receivable is needed to get paid on time and keep the cash flow going. The third, inventory, which represents the products that a company has in stock and is ready to be sold. It is important to manage inventory carefully, which can tie up cash, or overstocking, which can lead to low sales. Property, plant and equipment is the fourth, which represents long-term investments in the company's physical asset. To make sure that these assets bring the expected economic benefit, they need to be carefully managed. In conclusion, assets are the most important part of the balance sheet because they show how well a company is doing financially. By understanding the different types of assets and what they represent, entrepreneurs and non-finance person can make informed decisions to improve their financial situation. Now that we have covered the type of assets, let's talk about how to analyze them. When analyzing assets, it's important to consider both their current and their future value. You can figure out assets' current value by taking its market value and take into account the wear and tear or the fact that it is no longer useful. The future value can be determined by projecting future cash flows of the asset. Here is a practical example. Let's say you own a manufacturing business and have $100,000 in inventory. This is the current asset because it can be quickly converted into cash. However, you need to consider the future value of the inventory. If you are unable to sell the inventory within the next year, it may become obsolete and its value will decrease. In conclusion, if you want to make good business decisions, you need to know the different kinds of assets and how to analyze them. To wrap up, I encourage you to download the free PDF we have provided, where we'll dive in more detail on how to effectively analyze your asset. Thanks for watching. Don't forget to like, share and subscribe for more valuable insights into the world of finance and accounting. Thank you.